welcome to all of you as we dive deep into conversations about investments and wealth management, featuring some amazing thought leaders who will be joining me in a series brought to you by D Emerald Partners. I am Kavea R Chavali, and in this episode, I have with me a global personality who's a renowned investment professional with a range of diverse experiences across asset management globally and in India. Having traveled across 4 continents, she's a founding president of the University of Pennsylvania Alumni Club, a member of the Global Leadership Council of the Management and Technology Program, and a board member of the Association of Mutual Funds in India, AMFI. A keen microblogger on Twitter and also an avid bridge player. In fact, her unique life story has been narrated in the video, The Girl with a Broken Neck, that's also garnered over 1.8 lakh views. And I'm sure the moment I mention this video, all of viewers would definitely give an affirmative nod saying, yes, we watched that, and yes, we've been inspired. In fact, she started her career with McKinsey & Company and then progressed to become a hedge fund manager with AQR Capital, one of the world's largest systematic asset managers. She then moved to India to start her own venture named Forefront Capital Management, an alternative asset management firm, which was acquired by Edelweiss in 2014. She successfully led Edelweiss's acquisition of JP Morgan's mutual fund business and Ambit Capital's AIF business in 2016. Well, it's time to meet the captain of the ship, none other than Managing Director and CEO of Edelweiss Asset Management Limited, Radhika Gupta. So Radhika, firstly, a warm welcome to you indeed, and thank you so much for joining us in these series of talks. I'm sure you're as excited as I am about this conversation.
Yes, thank you, Kavya. Thank you so much for having me. Very excited to talk to you.
Absolutely, indeed. I think when we talk about finance, or for that matter, women in finance, I think one name that definitely stands out is you, Radhika. And I think our viewers will highly benefit from the conversation, from the kind of questions that I have in store for you, because I'm sure these are the questions that are on my mind, on everybody's mind. So without any delay, let's quickly begin with the very first question. I'm going to cut the chase and come direct to the present, which is 2021. And I'm sure when we look at the year 2021, we've seen a surge of IPOs in the equity markets. But according to you, Radhika, what do you think is the reason for this sudden frenzy in the fundraising amongst all these corporates?
So look, I think there are a couple of things. Obviously, what we're seeing is a larger than ever IPO market. But I think IPOs have been an important source of capital raising for many years. In fact, and I know we will speak about the fund, we've been tracking the IPO market for many, many years now. And India has always had a healthy IPO pipeline. And I think that's structural, and there are a couple of reasons. One is that over the last decade, a lot of private equity capital participated in India. And so while we are all public market investors, we didn't realize there was so much capital coming into the private markets, backing many, many companies. And these companies, this capital is now looking for an exit, and that exit is going to be via the IPO market. The second is, at the stage of development where India's capital markets are, there are a lot of sectors that are just not listed. And I think that's what's so exciting about India. I mean, your largest stock exchange is not listed. Your depositories are just getting listed. Your asset management companies, and BFSI is a sector that's close to my heart. So they're just getting listed. You're getting listed plays in retail. You're going to have listed. You don't have real serious fintech listed plays. So a lot of sectors are actually coming to the markets to get listed. So I think all of that, of course, coupled with a healthy equity market, which is when people want to take money off the table and people do IPOs in the middle of a good capital market, contributes to the fact that you're seeing so much IPO action. But I don't think it's just about the here and now. As I said, I think the trend is a lot more structural. This year probably is a little more smiles than usual.
There's this tonality of buoyancy, when you shared about this entire trend. So Radhika, that automatically brings me to the next question, as in, do you see this just like a very quick trend that will fade away, or do you think that it will definitely be long lasting?
So I think IPOs are structural, definitely. For the reasons I mentioned, I think IPOs are structural. Now, some year you may have 60 IPOs and some year you may have 20 IPOs. I don't think you'll see many days when you have 4 IPOs listing on a single day, which happened a few days ago. So I don't know if that's going to happen very frequently. But I think IPOs are structural. Now, I must caveat it with, when I say IPOs are structural, it doesn't mean that everything is going to make money structurally, right? People think of IPOs, and there are a lot of misperceptions about IPOs. I think the average investor today thinks take leverage, get funding, buy IPO, sell on listing. I don't think that is what it is. IPO is not an asset class as much as it is a stage, it's an event in the life of a company. And there are good companies and there are bad companies. And in seeing sort of capital markets for many years, I have seen that ultimately good companies find their outcome. They may have a really bad IPO, but 2 3 years later, they're delivering earnings, they're getting market share, they're being fair to minority shareholders, they're checking all the right boxes for the market, and they're creating wealth. And bad companies can have hype on listing day, and that hype fizzles out. So IPOs are structural, money making will still be selective.
I think that's a valid point, considering the way how a lot of consumers have started investing in IPOs. The way you had mentioned, they will wait for the day of listing and then immediately sell, make that quick profit. But as you mentioned, the good companies may not probably open well, but in the future, because of their performance, they will definitely perform well. So I think that's a very interesting thought that you've shared, Radhika. As we still talk about the IPOs, do you think NRIs, can they actually invest in IPOs in India? I think this is one common question every consumer ends up having in the mind, but can NRIs actually invest in these Indian companies then?
So NRIs can invest in listed Indian stocks subject to any regulatory restrictions that apply to NRIs, and they can apply because an IPO is nothing but a regular listed stock. So NRIs can apply, and I was, while I'm not an NRI, I have been one at some point in my life, through their brokerages and PIS accounts, NRIs can do this. The modus might be a little more complicated. And they can do it directly, and they can also participate in fund vehicles that give you exposure to this. So I think both options are available.
Beautiful indeed. Radhika, that also brings me to another very important point, which is to do with the kind of businesses, that are trying to raise funds. In fact, recently we've seen a huge amount of action in that space. But what are the kind of businesses, according to you, that are trying to raise funds? And are these traditional businesses like banks, FMCGs, or let's say generic pharma manufacturers, telecom providers? What do you think are these kind of businesses?
So, while they come in all bags, I think there is definitely a new age color to these listings. So, again, giving the example of financial services, I think your existing listed players are banks and NBFCs. What you're now seeing list is fintech, insurance, asset management companies, exchanges. So the less, in some case, balance sheet heavy, the more fee earning businesses, the more capital market focused businesses. This is one example. Old school technology was IT services in India. What you're seeing list is e-com, gaming. I mean, you had Nazara list recently. You have had traditional retail and a smart part. Now you'll have more new age retail with companies like Nykaa listing. You have had traditional pharma. You will now have more healthcare and healthcare services and diagnostics listings, so companies like Gland, etc., etc. So there's definitely what I would call a new age or new economy color to the listings that have come out, because the old sectors are largely listed and represented in the benchmark. It doesn't mean that a bank is not going to list, but chances are in financial services, you will see a lot more new age listings in the sectors I mentioned versus traditional banking.
And that's a very interesting term that you shared with regard to the fact that new age companies, and these are the ones that will definitely be following the action in due course of time. So while we are talking about the IPOs, we're also seeing, again, the new age companies. Let me take that conversation forward. For example, Zomato. That was, every Indian probably knew what was happening with regard to the Zomato listing, following it so keenly. When we talk about Zomato as an example, they are definitely getting fantastic valuation. But most of these companies that we hear are also loss making, where cash flow is not yet positive. So how is it that such companies are valued, and what is the rationale for getting such valuations and price them?
See, I think we have to change, and this IPO market, and I think this equity market is sort of changing the way we think about companies, all of us, and it's going to force all of us to do some rethinking. India was, in our capital markets for the last 5 7 years have been brought up on what I call this diet of consistent compounders. The consistent compounder is like, the really bright, hardworking kid who topped all the classes and went to IIT. You knew when the kid was doing badly. You knew the metrics. You knew how to evaluate him, and it was predictable and it was consistent. So your Page Industries or Pidlite or whatever. Your diet of consistent compounders, high ROE quality. Unfortunately, that's not the only way, and you have a single lens to value them. Unfortunately, that's not the only model that exists out there. Now, global markets have seen this to an extent, Chinese markets are seeing it. Indian markets are now seeing these companies list. So, are these companies loss making, or have they done all their capital expenditure a little early by being loss making? I think we all need to relook at the lens at which, from which we evaluate these companies. And I'm not making a specific comment on any particular listing, whether it will do well or whether it will not do well. As I said, some of these companies we can get huge valuations and end up being duds over the last 3-4 years. But I think the traditional metrics that we apply to company valuations for consistent compounders may not be as well applicable. I also think some of the comparisons that happen in capital markets these days are a little lazy. So, when that particular listing happened, there were a bunch of random WhatsApps floating around that, its market cap is larger than all hotels put together or larger than QSR plus X plus one. Things don't work like that. Markets are often a winner takes all game, especially in a high ROE business. I mean, the largest asset management company today is probably valued more than the highest wealth manager plus investment banker plus broker. These metrics don't work. So these kind of comparisons, in my view, are a little lazy. We need to have a fresher lens to look at these companies, evaluate these companies. And I think from a retail investor point of view, SEBI has been very smart here. They've capped the amount that retail investors should apply. So I'm also going out and saying that you should be very careful in your analysis of these companies. Because as I said, they're not the smart kid who goes to school and gets into IIT. They're the kid who can become an Olympic level athlete or do absolutely nothing. And you just don't know how to evaluate that kid because, it's not what you've grown up with.
Wow. I'm sure our viewers will definitely benefit from this analogy that you've shared with us, Radhika, because I think it was very simplified and explained so beautifully, because somewhere every consumer out there is sitting and wondering what exactly is going on. Plus, WhatsApp University is definitely never helping. So I think that was a very interesting nugget of insight for me as well. I'll probably take this conversation a little more forward in terms of understanding that are all the companies, for example, that are raising funds, are they really investable grade companies? Because now the kind of sectors that we're seeing in the market. So when we're talking about raising funds, are they really investable grade companies? And how does one know which company is investable and which is not?
So there are definitely some very serious investment grade companies. And by the way, the listed markets have some companies that don't meet the highest definition of quality. So let's be a little nicer to the companies that are IPOing, but there are definitely some serious investment grade companies. And do remember that these companies have been backed by very high quality private capital over the last few years that has taken positions and done serious diligence. So fundamentally, a lot of these are investment grade companies and a lot of these are also very large size companies. Some of them have 30-40% market share in the markets, that they dominate. So I think we have to see that. Obviously, listing is a different event. After listing, you require a certain set of communication with the market, a certain set of disclosures. You also require a certain consistency because ultimately equity markets want you to tell a narrative of what you're going to do, how you're going to make money, and how you're going to do it consistently. And I think that is what the challenge post listing is. You need to see a path to making money and delivering value, and doing that fairly consistently. I think listed markets are looking for a consistent narrative, but these are investment grade companies, or there are a reasonable portion. Now, the DRHP is the document for investors, as they know, that is filed before the IPO. Unfortunately, what happens is DRHPs these days are 400 pages. So it is extremely hard to expect a retail investor to, understand these DRHPs. But that is really the source, for professional managers like us, obviously. diligence is far more extensive than the DRHP, so we will do channel checks, we will do management reference checks, we will meet management, we will do all this in the run up to any of these listings. And we don't start studying these companies just when they're going to list. We usually start tracking them 6 to 12 months before, because before something lists, the dressing up starts. So you get, I think, a better bird's eye view of some of these companies a little before they list. But that's essentially how you understand companies.
Oh, wow. I think with regard to the DRHPs, as you had mentioned, I think retail investors somewhere probably just looking at the market trend, just looking at the noise that a particular company is creating. Do you see that happening very often when you interact with these consumers?
All the time. I mean, there is a tremendous FOMO factor in investing, and FOMO just doesn't apply to IPOs. It applies to buying funds, it applies to doing virtually anything, it applies to fashion. So FOMO definitely is present in IPOs. I will just recall my favorite IPO story for you from a different era, which is 2007 and 8. And I think the point I want to make to investors is that the listing day and hype doesn't determine how a company is going to do in the long term. So there was a company in 2008 on the day I got married that had I think India's largest IPO at that point in time. You can probably guess the company, but I won't name it. I think it raised 10,000 crores then. This was early 2008. Obviously, that hasn't been a tremendous wealth creator for investors. But about 6 months ago, before that, in the peak of the bull market, there was also another company that listed. It was a couple of 100 crores listing. It was down 30% on listing. It was a total washout. And that company is effectively a mid-cap, large-cap marvel today. That company is Page Industries. Now, if I had told you that Page Industries had a disastrous listing, was down 30% on listing, was not subscribed in some quotas, you won't believe it today, right? Because Page ultimately turned out to be a quality company. And that's why I said IPO is an event in the life of a company, and not all IPOs make money. Like if you ran a passive strategy, and because we run a fund, we also have, so we look at the top 100 companies that have listed at any point in time. If you just hold everything that is listed, you won't make too much money.
Right. Well, that's a crucial point there, because I think a lot of consumers think the otherwise. They probably, many consumers that I've been talking to, especially with regard to the Zomato listing, a lot of people had got in touch, because that's when people started taking notice that, oh, there is something like that happening that I can be part of. But I think this point that you've shared really puts a lot of puts the right lens, if I may put it that way. I think while you were sharing your IPO story, I thought I'll also wear my consumer's hat this time and ask you a question from that perspective, because with regard to IPOs, I in fact had been investing with Kane IPOs back then around 2006, 2007. But the amount of action I saw just this year, especially, I've noticed that a lot of people, they go about investing thinking, hey, they're going to get a chunk of it. And then they realize, no, SEBI decides how many institutional investors will get, how much retail investors will get. It's become like a gamble. It's become like a lucky draw, because that's exactly what happens. But I also want to ask you about one thing, is that if you had to explain to me or to the consumers outside in layman's terms, how could you probably tell them as to how does the IPO market work? How are these the companies that are listed, how are the shares allotted to the people?
Okay, so I think an IPO is an offering of shares, and there are different quotas. There is a quota, and for different kinds of investors. So there will be a quota for global investors, there could be a quota for domestic institutions, there could be a quota for retail investors, and there could be a quota for HNI investors. Those quotas are decided basis SEBI's rules, and the promoter looks at them and decides quotas. Now, different quotas are different for different kind of issues for obvious risk reasons. So if an issue is loss making, then the amount of retail allotment tends to be a lot less, because it's SEBI's way of protecting retail investors. Once you apply for an IPO, say there are 10,000 shares for the offering, and let's just assume there are no quotas right now. This happens on a quota basis, and then there's a spillover. But 30,000 people apply, you will get pro rata allocation. Retail investors' common frustration now is that, there'll be an issue for 10,000 shares and it'll be 250 times subscribed. So, there are all these memes going around about, I applied and I only got one share. And that is the reality, because when issues come to market, some of the popular issues are heavily in demand, because what happens is, till that point, it was private capital. Now, not only retail capital, but a lot of institutional capital looks at these companies. For instance, if a company is very large and it's listing, it's likely to become part of Nifty or Nifty Junior. It's likely to become a part of benchmark indices. So fund managers will have to look at the company very, very seriously. Some of these are actually phenomenal companies in themselves. I mean, you didn't have listed exchanges and one exchange listed, another exchange is listing. So there will be institutional interest, which is why there's a lot of demand. And it's hard, it's easier for institutions to place demand at the beginning because we run large size funds. Later, you just won't be able to accumulate the size, which is why, you see issues being 50, 100, 300, 400, 500 times oversubscribed, and these memes show up.
I think you rightly said about the kind of memes that keep popping, in order to, and I think, of course, memes are healthy, but memes, of course, memes also sort of, they might be entertaining, but they really don't share the actual information, what's happening. So coming to the actual information, if a consumer, Radhika, if a consumer had to come to you and say, Radhika, can you explain to me, how does the IPO allotment process happen step by step? Is there a step by step to this?
It's a very standardized, regulated process. There is a allotment period. So it starts with anchor investors. After that, there's an issue open for regular investors. It's a couple of days allotment period. You apply any time in that period. It doesn't matter when. And then basis the amount of applications and the total quota, there is an allotment. Now, there is no magic. It may feel like a meme, but it's actually a pro rata allotment. By quota, it's actually a pro rata involvement. Anchor is discretionary for the promoter and the merchant banker, but the rest of it is pro rata allotment. So I think the reason people are feeling the anxiety is just because there's a large amount of demand for these issues. Otherwise, it is very simple pro rata allotment.
Okay, so then if I have to talk about a retail investor such as how is it that I can get an allotment of these IPOs? For example, I hear that you have a fund that focuses and has over 90% of the portfolio invested in IPOs. So can you share some details about the fund for that matter?
Yeah, so the fund is called Edelweiss recently listed IPO fund. It was created in some way and in some not way to solve the problem that many of the memes are talking about in part, which is one of access. But it was also created to solve two more problems, which one is of selection, which I talked about in this conversation, because the fact is not every IPO makes money. And thirdly, of holding on, because IPOs don't make money just on listing, and it is never just about listing. I mean, keep recalling my page example. If there's nothing else a viewer remembers in this conversation, there is money to be made after listing. So this triplet issue of access, selection, post-listing day gains is what the fund was made to solve. And it invests 80% of its capital in the last recent 100 IPOs and 20% in also IPOs around that. We just keep that 20% flexibility. So if something becomes the 101st IPO, we don't need to churn. But essentially, it's a fund dedicated to investing and selecting the right IPOs. We are also an institution, so we can participate as an anchor investor, an institutional investor. Sometimes that's easier than when you're a retail investor, especially in a lot of these new economy issues. Institutional allocations are larger than retail allocations because of the rule. So that's how the fund works. It's an old fund, actually. It's got 3.5 years of track record. It was launched in 2018 as a small closed-ended fund. And then we converted it on demand to an open-ended fund. I didn't know that when we were converting it, we would be in the middle of this IPO boom market. I mean, to be frank, we got a little lucky there. But as I said, it's been a structural theme. But yeah, it's been, over the last month and a half since the fund has opened, Kavya, the number of individual investor subscriptions we get for this. In fact, we've got memes going around on this fund saying IPO ki problem yahan se solve ho jayegi, which is a separate thing. But if you're looking to invest in new economy companies, and that too for the long term, I would also highlight that if you're looking to do a fund like this, know that it invests in IPOs, which means it's risk taking. It invests in mid and small cap companies, and it is a long-term investment, just like any other equity investment. So it's a 5-year fund, by the way. I mean, it's an open-ended fund, but we really recommend you come in for 5 years.
Beautiful, beautiful. I think this is a piece of information for a person like me as well. And I think our viewers will also understand, as you mentioned, it's something for the long term. It's not as though they've sort of joined the fund and said, okay, now I want my money back. It doesn't happen like that. So I think this is something interesting. And I believe you had mentioned even about the anchor investment that you were talking about. In fact, anchor investor for that matter, because I understand that Edelweiss invests at times as an anchor investor. So how does this anchor investment process actually work? Are anchor investors always assured of an allotment, or is it otherwise?
So anchor investors are discretionary allocation basis the promoter and merchant banker in line with SEBI's rules. Anchor investors do get assured allotment. And we don't anchor every issue, I must say that, because anchor is a serious commitment to the company. So when we think a company is very, very exciting, when we think its fundamentals are strong and this is something we really want to hold, then we look at applying in the anchor issue. And, sometimes we are able to get anchor allocation, sometimes we're not. More often than not, we are able to do that. And so that becomes a material stake in the company. The anchor issue starts before the normal IPO. Sometimes we don't participate in the anchor issue and we participate in the main IPO as an institutional investor. And sometimes, by the way, there's a myth that we only participate on listing. So it's not just anchor and IPO. Sometimes a company is expensive on IPO, but 2 months later, it's fallen 20%, or it's had a really crappy listing and suddenly it looks really attractive and we buy it in the open market. So in fact, we've probably made less money on listing day gains, significantly less money on listing day gains than in buying issues in the open market, because between listing and 1 week after listing, the underlying business is not changing. But if its price changes and you get a better deal as an investor, that's really what you're in for. The idea is to buy new economy companies, whether you buy them in anchor, whether you buy them during the IPO, whether you buy them 30 days after listing, actually doesn't matter to us.
Okay, I must say that was a little dynamic moment for me to understand, because all of this information that you're sharing with us, Radhika, I think it sort of clarifies a lot of things, especially in the minds of the retail investors, because I feel somewhere with a lot of action happening, there's still this half knowledge or half-baked knowledge that is bringing them on board, listening to the friends and saying, okay, aapne wahan invest kiya, chalo main bhi dal deta hu. And then, the actual knowledge is still not there. So this literally clarifies a lot of things. This also brings me almost towards the final few questions, Radhika. In fact, it's a layman question again coming your way. What is the difference between qualified institutional buyer and anchor investor? And are these terms different or they can be used interchangeably?
No, so there are two different categories. So there is what we call a main book in an IPO, and that is for everyone to participate in. The anchor book happens a day before the main book. And if you've tracked IPOs, at the end of the anchor book day, the release of anchor investors, basically the purpose of the anchor book is that before the IPO opens, a certain amount of the IPO is already subscribed, and you show to the world that there is a committed set of investors who have backed this. Because even from the company's end, it is a gamble, right? We're saying getting allotment is a gamble. From the company's end, it is also tough, right? So that is what the anchor is. A certain category of investors are eligible. So an individual can't be an anchor. You have to be a certain kind of institution to anchor issues. And a qualified institutional buyer is also a regulated term to denote certain categories of institutions. It usually includes venture capital funds, mutual funds, FIIs, etc. And it is a category in the main book. In this context, when you're asking, it's a category in the main book. So they may be a part of the book for retail, they may be a part of the book for qualified institutional investors, and they may be a part of the book for HNI. The reason that these different categories are created is because all these different categories have different behavior. And even as a company, I would like my shareholding to be diversified. For instance, HNIs is often move in and out capital. Retail capital sometimes can be stable. Institutional capital has its own merits and value. So that's what these two things are.
That's an interesting learning for all our viewers as well. And let me then very quickly move on to the next question, which is to do with the selection of IPOs, because we were talking about how your company also sort of addresses this issue. But when it comes to the selection process of IPOs in Edelweiss, recently listed IPO fund, what exactly is the process that takes place?
So I think it is a process that we do to understand any company, by the way, and any fund. It's just that I think with IPOs, you have a little less information out there. So as I said, if it's a new listing coming to market, management quality is of the highest importance. So there's a substantial amount of time spent understanding management. There's a lot of time understanding industry because these are new industries, unlike a cement or a banking, which are established industries. You really want to understand the dynamics of the industry that is listing. Is this going to be an industry that is sustainable? Is this going to have margins? Obviously, you want to understand the company's position in the industry, its ability to command market share, its ability to make margins, and then obviously, some of its financial efficiency statistics. But I think management, the industry, your position in the industry, your ability to grow, these are the kinds of things that we look at. We classify companies into sort of two broad buckets. One is companies that are more secular in their ability to grow, and second is companies that are more cyclical. They'll do well in certain cycles and then they won't do well secularly. We take larger positions in companies that are cyclical and secular, and smaller positions in companies that are typically cyclical. And then obviously there are IPOs that we absolutely just ignore because we don't feel comfortable.
So that's an interesting checklist as well for the information of our viewers. And let's also then move on quickly. I know I'm going back to back, also being cognizant of the time that's in store. When we talk about certain success stories in your portfolio, is there something that you'd like to share, Radhika, with regard to how Edelweiss has been doing and any success stories that you'd like to share?
I mean, there's a long list of stories. For instance, there's an issue called SBI cards that we did. I think the first listed play in the card space, that was an interesting one. So that became one. Gland Pharma was an issue that we picked up, if I'm not wrong, after listing. So that did extremely well for us. A company that's now in many mid-cap funds, but was picked up by us, was Dixon. So that we held. I think one of the things when you see this portfolio of companies that you'll realize is, and when you compare it to traditional large cap funds and multi-cap funds, is you'll realize it's a very, very different kind of portfolio. So the names in your portfolio are going to be very, very different. Another interesting one that I think viewers might be familiar with is CAMS, which is the RTA. It's a play on the savings and growth of the asset management industry. So, this was one where actually listing gains were not great. So we did the main book, but we built the position even after the IPO. So that's an interesting one. As I said, I already talked about Gland Pharma. So that's an interesting one. There we did an anchor position. So various sort of names, and across sectors, I would say.
And that also brings me to the last question. While we spoke about the success stories or the ones that turned in your favor, were there also certain stories or certain moments that probably you made and it didn't fall in your favor? It didn't really fall in favor of Edelweiss per se.
Absolutely. And there will be. And look, there are going to be 6 months to 1 year periods, by the way, where the fund in aggregate doesn't do well. I think 2018, early 19 was a very rough period for the fund. Mid and small caps had fallen substantially. So that was a reasonably rough period for the fund. But I think on aggregate, see, we look at the portfolio on aggregate. And we look at funds that we did and funds that we avoided. So one interesting statistic is that the companies we invested were, and this data is about a month old, but the companies we invested in, their returns from listing till date were about 75% odd. The companies that we avoided were about 30%. So that I think is a good stat. So what you've invested in has definitely done significantly better than what you've avoided. And that's the benchmark that we look at.
In case, with your permission, if I can probably add one last question, and this is completely deviating from IPOs, from everything, but because I have you on board as our guest speaker, if I may ask you, do you see that women per se, when we're talking about women in finance, do you see a lot of women actually now, taking that initiative to invest more in the financial markets? Do you see that trend and upward surge right now, or do you think that it's been happening? It's just that now people have become more vocal.
Okay, so it depends on how you look at the glass. I think there's a long way to go. but each generation and each year is progress. I think if you looked at my mother's generation of women, they just didn't want to do this, right? They were like, I'm not financially savvy, I'm not into it. Now you have so many women's oriented forums, you have women's chats that are focused on personal finance. I think the younger Indian woman is more aspirational. And she's more aspirational in terms of her careers. She's more aspirational in terms of wanting to start a business or be an entrepreneur. And she's more aspirational about her money. And, she also comes with a certain confidence that perhaps she can understand finance. As I said, we have miles and miles to go, but we are making progress in the right direction. So I wouldn't say we've conquered it. There are a lot of young women who still say, oh, finance is not my cup of tea. I don't want to do it. Let me outsource it. But we're having a lot more conversations about it.
I love that optimism that you've shared, because that's also the ultimate truth. In fact, that's what we are observing. One final message, Radhika, from you to our investors, to our viewers who are probably trying to understand the IPO market. I'm bringing it back again, but one final message.
Remember, it's about buying good companies. IPO listing after doesn't matter. These are media words, and I'm saying this running a fund. These are events in the life of a company, and IPO is not, the be all and end all. You have to find good companies and invest in good companies.
I think that's a very strong yet a very endearing message that you've shared with our viewers, along with me as well. And I'm sure that this in fact turned out to be nothing short of a masterclass, if I may put it that way, Radhika. So I must once again thank you for your time. I must thank you for all the insights that you've shared. I think it's been very educational, which is what is the purpose of the series, to make it as simple and yet as profound for all our investors, all our viewers. So thank you once again, Radhika, for joining. And I do hope that we carry on more conversations. We get to learn more from you as well. I'm looking forward to all that and more. Thank you once again.
Thank you so much, Kavea.